Okay, so we're diving deep today into some serious market action, specifically that jump everyone's been talking about with the 10-year U.S. Treasury yield right after those new tariffs dropped on April 2nd.
Yeah, no kidding. It's been a wild ride.
It has. And
Yeah,
we had a great discussion about all this before, so we're going to use that to really break down what's going on.
absolutely.
I think the big question everyone's asking is what's really fueling this yield increase? And then there's that whole China angle to consider,
A
right?
huge one.
They hold a ton of U.S. debt. So how are they reacting to these new trade barriers? I mean, that's got to be factoring in.
Absolutely a major player in all of this.
But look, you're here listening to this deep dive.
Mhm.
You know how the markets work.
Right.
So we're going to skip the intro stuff and get straight into the nitty-gritty.
Agreed. We're talking to a savvy audience here. They're all over this stuff already.
Right. So the 10-year Treasury yield, it's like a heartbeat for the markets,
Yeah,
right?
for sure. It's one of those core indicators.
Exactly. And lately, it's been telling us there are some big shifts happening.
Major shifts.
So let's map out that upward trend.
Absolutely.
So the past week or so has been interesting, to say the least. We saw the 10-year yield actually dip below 4%.
Right.
But then by April 7th, it had bounced back up to 4.166%.
Quite a swing.
It really was. And it all started, with the new tariffs being announced, that baseline 10% across a bunch of countries.
Right.
But then China got hit with that 34% whammy.
Oof, yeah.
And the administration is talking about even more if China retaliates. So initially, after that news hit, the market seemed to be like, okay, safety first, let's go to treasuries.
Makes sense. It's that classic flight to quality. We see it all the time.
Mm-hmm.
When there's uncertainty, investors flock to those safe haven assets like government bonds.
Exactly. And that usually sends treasury yields down, right?
Exactly.
But this time, that didn't last, did it?
Nope.
That market sentiment took a sharp turn and those yields started climbing back up.
Yeah, it definitely shifted.
So what do you think were the main things that caused that reversal?
Well, a couple of things, really. First, those tariffs themselves immediately started ringing alarm bells about inflation. Higher tariffs mean pricier imports. And that can definitely feed into broader price increases across the board.
It's like a ripple effect.
Exactly.
Okay, so inflation worries start brewing, but then we also saw recession fears kind of ease up a bit.
Yeah, that March jobs report was a surprise. Stronger than a lot of people were expecting.
Definitely beat expectations.
Right. So maybe the economy's got a little more resilience than we thought.
Interesting.
And all of this is playing out against the backdrop of will they, won't they, with the Federal Reserve. Everyone's watching to see what they'll do about interest rates.
Will they cut them or not?
Exactly. And this whole trade war flare-up just adds another layer of volatility to the mix.
It's a lot to unpack, so let's stay with that inflation idea for a second.
Yeah.
If all these goods from China get a lot more expensive because of these tariffs,
Right.
that's got to affect how the bond market sees inflation going forward, doesn't it?
Absolutely. It has to.
And that directly impacts yields.
Yeah, bond investors are always trying to get ahead of inflation because it eats away at the real value of their fixed income. If they think inflation's on the rise, they're going to demand higher yields to offset that lost purchasing power.
Makes sense. So now let's talk about China. Everyone's been buzzing about how they might react to these tariffs.
Right.
Specifically by selling off some of their massive U.S. Treasury holdings.
It's a natural reaction to consider, given the whole tit-for-tat dynamic we're seeing in this trade war.
Exactly.
And it's worth noting that China's been steadily reducing their U.S. Treasury holdings for a while now. I mean, we're talking a decade-long trend here. They peaked at around $1.3 trillion, and now they're down to about $759 billion.
Yeah. It's been a gradual decline, but still significant.
Absolutely.
Yeah.
And it's been generating a lot of chatter online.
Oh, yeah.
There's no
Especially on Expo. There have been some posts going around about a recent $50 billion sale and rumors swirling that there's more to come.
Interesting.
So from a strategic standpoint, why would China even consider this kind of move as retaliation? I mean, what's the logic there?
Yeah. Well, it's pretty straightforward, really. By selling a large chunk of U.S. Treasuries, China could push those yields higher.
Okay.
And higher yields mean the U.S. government has to pay more to borrow money.
Makes borrowing more expensive.
Exactly. And that makes it harder to finance all that debt.
It's like a financial pressure tactic.
Exactly.
Okay.
A way for China to hit back financially. And of course, we can't forget that China has already announced their own retaliatory tariffs.
Yeah.
34% on U.S. goods starting April 10th.
Right. But here's the thing. There's been no official word of a massive treasury sell-off directly linked to the tariffs.
Right.
And yeah, yields are up, but we're not seeing the market completely freak out.
Right.
So that suggests any selling that's happening is either pretty small scale,
Hmm.
or it's being absorbed by other buyers stepping in.
Yeah, it could be.
So why wouldn't China just go all in and dump a ton of treasuries, to really show they're not messing around? What's stopping them?
Well, the thing is, a massive sudden sell-off like that would come with some serious risks for China. It's like they'd be throwing a boomerang.
A boomerang. What do you mean by that?
Well, think about it. U.S. Treasuries are still a really important part of China's whole financial system. Even with all this geopolitical tension going on, they offer a level of liquidity that's hard to beat. You can buy and sell them easily.
Yeah.
And being in dollars, they're essential for managing the yuan's exchange rate
Okay.
and for facilitating international trade, especially for anything priced in dollars, like oil.
Right.
Plus, holding a bunch of stable assets like treasuries makes China look economically stable. So a fire sale would jeopardize all of that.
So they're in a bit of a bind then.
Kinda. If they suddenly flooded the market with treasuries, the price would tank. And since they own so many of them, they'd basically be devaluing their own assets,
Ouch.
right? Some estimates say if they sold off $500 billion worth, they could be looking at a $100 billion loss.
Wow, that's a big hit.
It is. And beyond that direct impact, it could really shake up global markets, trigger instability in the yuan,
Yeah.
and even lead to capital flight from China.
Capital flight. That's when investors start pulling their money out of a country, right? Exactly.
Wow, so that would be a nightmare scenario for China.
It would. And, they're already in a tricky spot with their export-dependent economy and all that debt they're carrying.
Right.
Adding a self-inflicted financial shock on top of all the tariff pressure, that's a recipe for trouble.
It all makes sense now. So
Yeah.
instead of making a big splash, it seems China's been playing a longer game with their treasury holdings.
Exactly. It's been more gradual, more strategic.
So for a while now, they've been slowly but surely reducing those holdings.
Right. And this isn't just about the latest round of tariffs. This is a long-term adjustment, a recalibration of their strategy.
Okay, so what's the thinking behind this longer-term diversification?
Well, there are a few key reasons. The main one is that they want to lessen their reliance on the US dollar. The world's getting more and more unpredictable geopolitically. And there's always the risk of sanctions or these trade wars dragging on.
It's like hedging their bets.
Exactly. By diversifying their reserves, they're spreading the risk. We've seen this play out in a couple of ways. For one, they've been increasing their gold reserves up to about 200 tons now.
Oh.
And they're also shifting more towards assets denominated in euros and yuan.
So moving away from the dollar little by little.
Right. And those gradual treasury sales, that helps fund domestic initiatives too. Things like the Belt and Road Initiative and all those investments they're making in becoming technologically self-sufficient.
It's like a multi-pronged approach.
It is. And it gives the yuan a bit of support against depreciation pressures too.
Interesting. So that slow and steady pace, selling off roughly $500 billion over a decade, that's key to avoiding those market meltdowns we talked about.
Exactly.
It's about finding that sweet spot between moving away from the dollar
Mm-hmm.
and keeping everything stable.
Right. They have to strike a balance.
And even after all that, China still holds a ton of U.S. debt.
Second only to Japan, they've got about $1.1 trillion. Wow. So that $50 billion rumor we talked about, that could just be them continuing this slow and steady shift.
Could be. It's a measured response, not a knee-jerk reaction.
Strategic maneuvering.
Precisely.
Okay, so last thing I want to touch on is whether China might shift some of those reserves into other dollar-denominated assets,
Okay.
specifically U.S. equities, like the S&P 500. At first glance, it seems like a way to stay in dollars, but maybe get better returns.
Mm-hmm.
But why wouldn't that work for them? I mean, they've got huge reserves to manage.
Well, you see, when you're a central bank dealing with trillions of dollars in foreign exchange reserves, your priorities are different than your average investors.
Right. That's a whole different ballgame.
Exactly. Liquidity is king.
Yeah.
You need to be able to turn those assets into cash quickly if you need to, say, to stabilize your currency. And the treasury market is way deeper and more liquid than the stock market.
Ah, I see.
And then there's safety tenants debt. U.S. debt is generally seen as a pretty safe bet.
Yeah.
The S&P 500, not so much. Remember 2008?
Yeah, the crack.
Exactly. Big swings in value. Central banks don't like to gamble with their core reserves.
Makes sense.
And don't forget, those reserves are primarily there to facilitate trade. Holding a massive stock portfolio that could fluctuate wildly doesn't really support that goal the same way stable dollar-denominated treasuries do.
Right. So it's about function as much as anything else.
Exactly.
Plus, there's the whole geopolitical angle. It'd be a pretty mixed message if China suddenly pumped a ton of money into U.S. stocks while we're in the middle of a trade war.
Definitely complicates things.
Yeah.
How would that play at home? How would other countries interpret it? Lots to consider.
It's a delicate balance.
Yeah,
So just to be clear, we're talking about China's state-managed foreign exchange reserves, right? The ones managed by the People's Bank of China.
right. Their mandate is to be conservative.
Right. It's different from their sovereign wealth fund, the China Investment Corporation. They do invest in equities.
But the state reserves are way bigger, but $3.2 trillion. Their core function demands a more cautious approach.
So it's all about managing risk.
Exactly.
Mm-hmm.
Imagine if they put even $500 billion into the S&P 500.
Yeah.
That's like 10% of the whole index.
Wow.
They'd have a huge impact and potentially too much influence.
So wrapping it all up, it seems like these higher treasury yields we're seeing, they're a result of a bunch of factors.
It's multifaceted.
Inflation worries because of the tariffs, some easing of recession fears, and the uncertainty around what the Fed will do next. And while China might sell some U.S. treasuries to push back against these trade measures, a huge sell-off would be a really risky move for them.
Absolutely. It could backfire big time.
Their long-term strategy seems to be about gradually diversifying away from the dollar.
Right.
And U.S. stocks just don't fit the bill when it comes to their core reserves.
They need something more liquid, more stable, and something that directly supports their trade activities.
So basically, China's walking a tightrope here.
They are trying to figure out how to respond to this trade war,
Right.
but they also have to keep their own economy stable.
It's a tough balancing act. So for everyone listening who's been following this, keep an eye on those treasury yields and pay attention to any hints from the Fed,
Good advice.
because those are going to be key indicators of what's to come in this whole U.S.-China trade saga.
Definitely. Things could get even more interesting.
They could. Thanks for diving deep with us, folks.
Absolutely. Always a pleasure.
Until next time.